And I appreciate everyone coming this morning, and I'm sure it's going to be a interesting morning. So I want to remind you that all the lines are muted, but you can ask questions in the chat, and we will deal with those questions after the webinar. Also, we'll open up the lines after the webinar so that we can answer any questions that you might have. So first I want to talk a little bit about Oasis Solutions Group. We are doing this webinar in conjunction with Shymanski Company. Oasis Solutions Group was founded in 1991, and we specialize in accounting, CRM, and HR software. We also provide consultation to determine if there is a right fit for one of the products that we might have. We offer training and implementation on all the software we recommend, and also offer a local help desk. Product specialties, Sage Accounting Software, CRM, and Human Resource, NetSuite ERP, NetSuite HR and CRM, Sugar CRM, and Salesforce.com, which is another CRM product. A little bit about myself, and I am Annette Manias with Oasis, and I'm the president. I founded Oasis Solutions Group in 1991. Actually, tomorrow, May 1st, is our 24th year. We're going into our 25th year starting tomorrow. So as you can imagine, I've worked every position in the company, and I currently lead the sales team. And as anyone knows, for a owner of a company, I also do a lot of different things too. So, but my passion really is working with businesses to assist them in gaining more efficiencies with software and figuring out what is the best solution for them. So it excites me to be able to work with different customers and prospective customers and in helping with their systems. So my expertise and Oasis expertise is in manufacturing and wholesale distribution, service, not-for-profits, financial institutions, and trade associations. So we have varying industries that we work with. So a little bit about Shymanski Company. I know there's a lot of people on the call that already know Shymanski, and we appreciate you guys coming this morning. Shymanski is one of the largest accounting firms in southern Indiana and Kentucky. Been in service since 1975 with a wide range of experience. They are part of the McGladrey Alliance firm. Full range of services: accounting and auditing, advisory services, outsourcing services, tax consulting and compliance, and medical billing and consulting. So a little bit about our speaker this morning, Scott Olinger. Scott is the Vice President in the Accounting and Auditing Department, and he is Vice President in charge of the Louisville office. And he joined Shymanski in 1996, and he's a co-leader for the manufacturing team. Scott got his degree in accounting from the University of Southern Indiana, and he has several certifications: Certified Public Accountant, Chartered Global Management Accountant, and Certified in Production and Inventory Management through APIX. That's a whole mouthful. So his service areas are accounting and auditing and consulting services. And then, of course, his industry expertise as well. Includes manufacturing, wholesale distribution, construction, not-for-profits. So it's a wide range of expertise as well. So on the right-hand side of your screen, you'll be able to see the contact information for Scott. He is our presenter today. I have heard him present this topic many times. It's very interesting. You will find it interesting and almost horrifying at the same time on some of the slides, and you'll see what I mean in just a minute. So we appreciate everyone coming today, and I noticed on the call, I just want to say this, there's not a whole lot of Louisville people on the call, maybe a couple, because we are right in the middle of coming up on Derby on Saturday. So we appreciate everybody coming today, and this webinar will be recorded, and we'll be sending this out to everyone after the webinar. So I'm going to turn it over to Scott now, and please, again, ask questions. Put it into the chat box on the right-hand side, and we will get those answered. Thank you. Okay, Scott, we're ready.
All right. Well, thank you, Annette. Appreciate that very much, and thanks for the reminder about Derby tomorrow, but I'm actually heading over to the Kentucky Oaks right after this. So one of the things I wanted to see is, I know you mentioned in the chat area where they could ask questions, but I'm also hoping to potentially get some tips or something on certain horses. So if you guys can send those in to me, that would be outstanding. Wanted to let you know a few things that we'll be talking about today. Actually, just the primary thing is the reducing tax burden. Now, this piece that I'm doing today, this part of the seminar, is actually part of a larger seminar that I did. It's just called Keeping More of What You Earn. Today's piece, though, is primarily going to be around reducing your tax burden. I'm sorry, we have a little problem with the slides here. So that's today's focus. As we go through the presentation, one of the things I want to remind you is we'll be going through this at 30,000 feet, so we'll be covering a lot of things very, very quickly. There likely may be a lot of questions about how to do certain things and implementations and how it might impact your specific company, and happy to try to help you with some of those. We may not be able to cover them on the call, but if you leave your questions, we certainly will try to get back with you afterward. So what is more? You know, I think one of the best things I've seen as far as a definition about what is more is this AT&T commercial that a lot of you probably have seen before. And this cute little girl here says, more is better than less. If you really like something, you want it more. We want more. We want more. Like you really want it. Like we want more. The guy says, I follow you. Sometimes I find myself in that situation, sometimes talking with clients. We know we want more, but we're not quite sure how to get more, and so a lot of it just requires conversation, and we'll talk about that a little bit more in the future. So let's talk about the primary thing today is talk about reducing your tax burden. And one of the things that a lot of people don't realize, company and owners generally spend up to 50% or more of their profits on taxes. And what we often find is taxes are not necessarily managed with the same level of planning that sometimes your other areas of the operation might be. So the question is, how can you keep more of what your company earns? And one of the things I'd like to have as a takeaway is how to learn how to engage yourself and others in effective tax planning. And then from that, to be able to identify potential strategies or opportunities that your company may not have considered yet. Now, jumping into this, as I had a chance to look at the participant group earlier, it looks like we've got an pretty wide industry range. We've got some manufacturing, distribution, looks like some service companies on here, construction, financial services, staffing, and utilities. So a lot of companies represented here. So hopefully, I'll try to connect to your industry at some point through this presentation. Okay, this first slide in here that I'm putting, I really just do this as an opportunity to just impress everybody on the call today. And this is a slide of the time we spend working each day just to pay taxes. And so this is for the typical taxpayer. They spend about 1 hour and 55 minutes every day just working to pay taxes, and you can see roughly, this is an eye chart, so you can't see all the details, but you see all the different places that the taxes go. You can see it goes to Social Security, Defense, Social Security or income and security, Medicare, health, and a variety of other places. And so, out of your 7.5 hour workday, an hour and 55 minutes every day goes to just paying taxes. So that's so much fun. Question I get a lot is, will simplification happen? We hear that every year, and we, especially around election years, we talk about tax simplification, flat tax, sales tax, and things like that. And the thing that I continue to go back to every time I hear that is in 1913, when the income tax regime was put into place, it started out with 400 pages of code and regulations, and has substantially increased every year. Now, they did have two valiant attempts at simplification back in 77, and when they did that simplification in 77, you can see that the pages actually went from 19,000 up to 26,000. They also did some more simplification in 1986, and they did a nice job of increasing the pages from 26,000 to 40,000 pages. So every time I hear the word simplification, I start thinking more complexity, unfortunately. So that's just a little history of how that's all come about. Now, hopefully we can come to a simplification, but I'm not banking on it today. To put a little context around the importance of tax planning, I want to talk a little bit about just the financial shape of our federal government. So today, if you were to pull up the financial statements of our federal government, you'd see that we have assets of $3.1 trillion. We have total liabilities of $21.2 trillion and an accumulated deficit of $18.1 trillion and climbing. And the scary part is if we just looked at that maybe 8 or 10 years ago, I think we'd see that that's nearly doubled in that amount of time. Here's the other part that's really scary. If you were to go to the financial statements for the U.S. government, you can take that cumulative deficit of $18 trillion and you can add on to that the additional Social Security insurance deficit that we have of $61 trillion, which actually leaves us with a total accumulated deficit of $79 trillion. So quite sobering numbers, and I think this might have been one of the slides that you were referring to that just makes you kind of cringe.
Right, right. You know, and Scott, I was telling you the other day that I got a letter from the Social Security, you know how they say that what you're going to get from Social Security when you retire, and down at the bottom I noticed there's a little note on it that said, basically saying, you may really not get this, that this may be something that will not be there for you, which was a little scary because I had not seen that note before.
Right. Yeah. And I, for one, probably haven't. I kind of think I may not get it anyway.
Right.
And so
you
definitely
can't bank on it.
Can't bank on it.
Yeah.
But certainly we do have $61 trillion out there that we owe to somebody. This slide here tries to put into context how did we accumulate that deficit. And so if you look at the red line on here, that represents the net cash outlays that's as a percentage of our gross domestic product. The blue line represents the actual receipts that the federal government receipts as a percentage of the gross domestic product. So if you were able to see that, you can see back in the Great Recession, right at 2008, 2009, 2010, you could see that it expanded dramatically at that point in time, and that area in there is what's really created a huge deficit that we're seeing today. The good news is that gap is starting to come together a little bit and continues to come together, and so I'm hopeful that we might be able to come to a near balanced budget at some point, but we do have an election coming up, and so we get a lot of changes and things like that happening. So hard to know what's going to happen, but at least we are heading in the right direction at that point, but certainly have a hole to climb out of. So what's all that mean? Well, the reason I put all that in there is like I said, to provide context that we're probably not going to see tax rates going down anytime soon, or at least total taxes paid. There may be changes in rates. There may be changes in the way that companies and corporations are taxed, but really not sure that we're going to see a significant reduction in the amount of tax that individuals and companies may be paying in the future. So where do we pay our taxes? Here's just a sample of certain places that you're paying taxes and fees to the government. I'm not going to go through each one of these, of course, but it just gives you an idea that there's so many places that you're either directly or indirectly actually paying taxes in day in and day out. And so the question is, where do you pay the taxes? And this slide that's on here is just a screenshot of what someone did to try to map out where they're paying their taxes, just to try to get their arm around, gee, is there something we can do about this? And they put together a mind map. So this is just an example of a mind map that someone did around that. But it looks so complicated, and really the question is, where do I start on that? And that's really what I want to talk about today. Is we're not talking so much about specific strategies. We'll dive into a few specific strategies, but a big part of it is just how do I get started? And I'd say it all starts with I. It all starts with you. But if you look at it, the first step is just the initiation. And the fact that you're in this meeting today might be part of the initiation process, but someone has to own it. A lot of times I'll find people might expect that their CFO or their controller might own the tax planning, or that their CPA firm might own the tax planning. And the reality is not just one person can own it. And what I found is the best situations where tax planning occurs is when the owner is taking a very important role in that, and sometimes is initiating that. So once you get the initiation, then you get to the involvement piece. Who should be involved? We said the CFO, the controller probably shouldn't be involved. Certainly yourself, your CPA, maybe your tax attorney. There may be other people in your financial world that should be involved in the discussion. And the reason that you want to think about it is the involvement is that leads you to the next step, which is to get good information. Hopefully by getting together in a group and having a discussion about where our taxes are being paid, we can get some good information, which will lead to the next step, which is the insight. From information, you get insight. And hopefully from insight, you can start to get some ideas. So earlier I showed you this complicated little tax planning map that one company used, and for purposes of our presentation today, I thought I'd show just a little simple tax mind map that you could use as a starting point. And every company, for example, could go through here and just say, this is my business right in the center. And around that, there's all sorts of different things that I can start to think about. I've got ownership issues. I've got operational issues, multi-state issues. Am I doing work internationally? Everybody's got people issues. They got property. What kind of entity should I be? What kind of accounting methods do I have, or should I have? Do I have inventory, and what am I doing about risk management? And so that's just a quick idea of what might come up when you do your own tax mind map about where am I paying taxes. And the point here is really, what are the drivers? Each one of these things are specific things that happen in your company that are really driving your operations, but also in turn then driving where you pay your taxes. When I do this presentation as part of a larger live group, we will actually sit down and take some time to try to map out for a specific company. In this case, I just went ahead and put together what a few things might have that may have come about from that discussion. So, for example, if we look at ownership, we realize, okay, well, I'm a 2% owner in a S corporation. One of the things I've seen a lot, and the reason I start with this in this particular presentation is I see this wrong more often than I see it right on S corporations, is if you're an owner and you've got health insurance that's being paid by the company on your behalf, you actually get to take that as a deduction on the company, but you must pick it up as income on your W-2. And Annette, I think you had seen that in some situations as well in your client base.
Right, yeah.
So we know that it happens very often, and the thing about that particular one, and I won't spend a lot of time on this, but it's all about the compliance piece, just making sure that it's on the W-2. At the end of the day, the amount of tax that gets paid is correct, or is exactly the same as if you don't. But the problem is if you don't put it on your W-2, which allows you to take it as a deduction on the front page of your 1040, the IRS can come in and audit and say, oh, well, listen, you didn't pick this up as income on your W-2, therefore we're going to pick it up as other income on your 1040, but since you didn't put it on your W-2, you don't qualify for this benefit, so we're going to take the health insurance and put it on Schedule A, and that's generally limited to 10% of your AGI, and so it gets lost. So the point there is just to make sure that your health insurance is getting picked up on your W-2s for any owners that's greater than 2%. The other thing that comes up in the ownership bucket that really comes into play is capital gains. And the point that I'd make on capital gains is that there's a huge difference between the ordinary tax rates that you're paying, which represents the blue line on this chart. If you went from through the history of the years here, the blue line represents the percentage of income that's being paid as an ordinary rate. The red line represents the percentage of tax on a capital gains rate. See, there's a huge difference between the two of that, and so there's a huge benefit to being able to create capital gains versus ordinary gains and ordinary income. And so what you'll find is a lot of where the money is, and the private equity firms and things like that, you get this thing called carried interest on the hedge fund managers, and they use this thing called 2 and 20, which basically means that all the income that they're being taxed on in general is subject to capital gains rates, which is at the much lower rate versus the ordinary rate. And you can see that's such a big advantage. Now, take into account the other thing is a way to do that is continue to invest. Invest in your business, invest in aligned things like owning your own building, perhaps. You may be able to get partial capital gain treatment by owning your own building. You're paying rent to yourself, but the value of your building is going up, and so later when you sell it, you may be subject to some recapture called 1250 recapture. We won't go into the details, but anything that increased over from the time you purchased the building to later on is actually subject to capital gains versus ordinary gains. That's a good thing. And the other thing that I'm starting to see more and more people get into, especially in the entrepreneurial world, is starting up a business is for the purpose of selling it. And if you start up a business for the purpose of selling it, of course, while you're working through the business and the startup on the front end, you may have some income tax, which is subject to ordinary gains, but the real win and what they're looking for is that exit, that place where they sell the business and they walk away with that purchase price. And in those cases, if done right, a significant portion of that sales price is subject to capital gains rates, and allows you just to continue to parlay what you're doing into, you have more money at the end of the day if you get capital gains than if you continue to operate, unfortunately, in some of those scenarios.
I have a question real
Sure.
quick, Scott. The capital gains tax percentage went up a couple of years ago. Do you ever see that going back down?
That's a great question, and I don't have a crystal ball on that, but here's the reality is, so the capital gains rate, as you mentioned, was 15% just a few years ago. It went up by 5%, and then really went up by another 3.8% because of the Medicare surcharge related to the Affordable Care Act or Obamacare. And just the 5% increase got you to about a 50% increase, a 33% increase in tax immediately right there, along with the 3.8. So we really had about a 50% increase plus in the tax rate. Do I see that going away anytime soon? Probably not. I think with the way the House and the Senate are set up right now, I think we're going to see it probably be in that place for quite a while, and there doesn't seem to be any momentum toward removing the Medicare surcharge that's out there. So I think the numbers we're looking at today are probably here for a while.
Okay.
One thing I'd mention as well is that ownership. I'm seeing more and more people do this, is self-directed IRAs, owning businesses or investments, passive investments, for example, in self-directed IRAs, where the increase in value in those companies may not be taxed until you're actually retired. So it's an ownership vehicle that many people have not heard about, and is I'm seeing used sometimes, but often not a tremendous amount, because there is some complexity around it and there's a lot of compliance around it. But I'm seeing some momentum around ownership being used in the use of self-directed IRAs, and specifically around real estate. I'm seeing a lot more people investing in real estate for the purpose of when those future gains come around, that they won't be taxed, and they continue to parlay that until retirement. The caution on that is you can't use your own real estate. So you can't have a building that you're using for your business and rent it to yourself. That's considered self-dealing, and unfortunately it's a prohibited transaction. But if you want to invest in real estate that you're currently not involved in, that could be a great place to do that. The other thing is estate planning. Again, this falls in the ownership bucket that we're talking about, and I want to click into the estate planning arena, and don't want to go into great detail on that, but a lot of times when people think estate planning, they think taxes only, thinking about reduce the tax, but really there's some 4 key areas, I think, is how do I handle distributions, how is the trust going to be administered, how is the income going to be handled, and then taxes comes into play. But I would say if estate planning is not something that's been considered to date as part of that ownership bucket. I think it's something that you definitely want to look into and get started on. And this is a quote that I had heard from someone before. It says, asset protection is probably one of the most important aspects of estate planning and preserving a legacy for your family. It involves more than just providing liquidity for payment of federal and state estate taxes. It's more about the legacy. And that actually, I believe, came from a client who said that to me at one point in time. So the invaders of your state, if we're talking about that, it's the IRS, of course. It's inflation, poor investments, medical expenses, divorce, lawsuit, and creditors. And so what can you do to help avoid the IRS getting involved in some of that? There's an entire alphabet soup of things that you can do that are just traditional estate planning techniques that you'll want to become familiar with as an owner. So going back to home base again, this is back to the tax mind map. Don't forget the purpose of what we're talking about today is about the idea about tax planning. It's what are the things I should be thinking about in those particular buckets. Operational issues. Let's say you're a manufacturer or a construction company. You should at a minimum know about the term DPAD, which is domestic production deduction. We are still continuing to see some companies in the manufacturing space and construction space not taking advantage of this deduction. It's about 9% of the total net income of the company. So if you're not familiar with that term, domestic production deduction, or sometimes it's called domestic manufacturing deduction, be sure to get to know that one. The other one that I very often am not seeing taken again in the manufacturing segment is around R&D tax credits. And I will drill down on that slightly because I think it applies to many of the people on the call. So if you're currently doing the research and development tax credit, you can go get yourself a soft drink right now. But if you're not, you may want to pay attention to this. So R&E tax credits are basically for new product developments, product improvements, or, and this is the big one that gets missed a lot, is process improvements. Okay, so if you're doing things within your plant to actually be able to produce things more effectively, cheaper, better, faster, those things can qualify for research and development tax credits. In fact, a lot of people are doing lean initiatives inside their company. A lot of times those lean initiatives that are being done may qualify for the research and development tax credit. And if you look into the details of it, there's really a 4-part test. But there's really 2 of them that really matter. It's the elimination of an uncertainty, and I would say that that's really just there must be some uncertainty. You can't enter into something knowing what the outcome is and still get the credit. It must be technological in nature, so it has to be either a physical science, a biological science, computer science, or engineering. Engineering's a big one, especially around the lean manufacturing area. You tend to get a lot of engineers involved in that process. And then the last thing is the process of experimentation, or said another way, it's trial and error. You know, I know that I'm going to be trying one thing, it doesn't work out, so I'm going to try another thing. The cost of all those things can accumulate and be part of what's called the qualified expenditures. So the costs that are included in the credit calculation are qualified expenditures. The biggie is wages. Okay, so you've got some direct labor on that. You've got the actual engineers that are working on it. You may have supervisory people on that, and you also have support people. So what I always say is you get to pick up some of the costs of the people that are actually working on the projects, and you get a layer above and a layer below to a certain degree. So that's the biggie. That's about 90% of the costs that get picked up in doing research and development. There's also then some supplies that may be used in contract research, but based on what I see in most cases, that is by far the smallest piece. It's all about the wages. It's all about the people involved. And so this chart here shows you cost, effort, and risk. If you get cost, effort, and risk, if you got enough of it, chances are you may qualify for the credit. Question is, how do I calculate that? How much is it worth? Bottom line, it's about 5 to 6% of whatever you can put into that bucket, qualified expenditures, qualifies for the credit. Now it is subject to AMT, so if you're in alternative minimum tax, the credit actually can't be taken. It gets carried forward into future years. So before stepping into, you want to understand if you're in alternative minimum tax. And I know we have some people from, I know we have Kentucky and Indiana on the line today. In Kentucky, sorry, Kentucky does not have a research and development tax credit, but Indiana actually does. And if you do this research in Indiana, you can actually take this calculation and approximately double it. And that is not subject to an AMT limitation. So continuing to go around the bucket, we've talked about ownership issues, we've talked about operational issues. You've got to get a feel for how we're doing this now. In those buckets, there's certain things that may come up in that discussion. As an owner, as the CFO, as having the accountant in the room, you're brainstorming about these things, and things are going to find their way into those buckets. We know we've gathered information, we've got some insights, and now we're coming up with ideas. On the multi-state issue, I won't spend a lot of time on multi-state except for two things, incentives and compliance. And the point I want to make about incentives is that if you're planning on doing any future growth, expansion, adding new people or things like that, oftentimes states are looking to bring business in, as well as localities. And you see this a lot in the news where states will offer tax credits to companies to relocate there. Well, they'll also pay tax credits to retain you there in some cases, or to hire more people. And so, but the key is you have to qualify for these two words in parentheses or in quotation is but for. Remember that word, but for. I would not do this project but for the fact that I need these incentives in order to be able to make it work. And it's really difficult to be able to use the but-for argument if you've already started down the road of the expansion. So I've seen a lot of people that have started the process. They're in a state. They may have bought a building, or they've got a purchase agreement on a building, and then they want to try to get state incentives or try to get property tax reductions, and no one believes the but-for argument at that point. So that's one of the things I want to mention about multi-state. And the other thing is about compliance. We've got so many clients. We've got clients that are doing business in all 50 states. Okay, and there's this feeling sometimes that I really just don't want to have to pay tax in all these different states. And the thing that I would point out about paying taxes in other states is it's not necessarily always a bad thing. And there's two buckets that we'll talk about. We've got C Corp taxation, and we have pass-through taxation. On C Corp taxation, there could be great reasons to do business in multi-state and file tax returns in other states, because there are actually some states that don't have a state tax. And if you live in a non-throwback state, you may actually have some places where you never pay state tax. But if you don't file those other state tax returns, it's hard to show that argument that you actually are doing business outside of your sole state that you're in. And the other side, and this is the one I see more often, is on the pass-through side, an S corporation or LLC, is, well, I don't want to mess around with filing a tax return in Indiana, Kentucky, Illinois, and Ohio. I'm just doing a small amount of business there. Well, the reality is at the end of the day, you pay about the same amount of tax if you file in all those states. And the reason for that is when you pay that tax to Kentucky and you're resident in Indiana, you get a credit back for the amount of tax that you paid in Kentucky. You get that credit back in Indiana. It may not be dollar for dollar, but generally it's fairly close. But here's the risk, is if you don't do that, we run into this whipsaw effect of the statute of limitations. Let's say we're going down the road 10 years, and I've been doing all my work in Indiana, but I've been only paying taxes in Indiana, but I've been doing work in Kentucky and Illinois and all these places that haven't been paying taxes in the past. Let's say I go into Illinois, and Illinois realizes now 10 years down the road that I've been there, but I've never filed a tax return there. They can actually come to you now and say that we want 10 years worth of back taxes. Well, unfortunately, in that case, I'm going to have to pay the 10 years of back taxes, but I'm going to be limited to what credit I can take now on my Indiana return in that example to only the years that are still open under statute. So that's not a good outcome, and we actually have seen that happen in some clients. I think the largest impact I recently saw came out to be about a $250,000 impact of back taxes in a state that ultimately they weren't able to offset. And had they filed in those in all the states, I think the impact to that would have been very minimal, and so it was detrimental to that particular company.
Scott, I want to, if you don't mind, I want to interject a little bit because the multi-state is for a lot of our customers is a big question, and part of it for us is on the sales and use tax piece of it, and there are softwares that we have that interface with different accounting systems that can track that tax and make sure that you're compliant with it. So it's interesting because when you look at different states, some states break the sales tax down even to counties. Mm-hmm. So you're paying county tax and the state tax, and if you're not compliant with that, you could get into trouble. So that was one of the things that we see a lot of is our customers getting into that sales tax issue. So so if anybody has questions about the sales and use tax and how that can be automated, just let me know.
Great. Thank you, Annette. Moving on to the international bucket, I think when I looked at the group that's here today, there's definitely some people that are involved in doing some sales internationally. If you're doing sales internationally, exporting, you may want to look into what's called an IC disc. If that's a term that you've not heard of in the past, is the IC disc. Essentially, it's a way to be able to convert a significant portion of the income of the company from essentially ordinary tax rates to dividends tax rates, which are currently taxed at the capital gains rates. So we're seeing a tax arbitrage in the neighborhood of 20% on the amount that can be transferred into that. And if I may just click briefly down into that, this is what that looks like. Without going into great detail, I'm going to go down to just a quick calculation of how that might be done. So let's say, for example, if you had $20 million in gross receipts that you're selling internationally, you're limited to about 50% of the net income or 4% of the receipts. So in this case, let's focus on the 4% of the actual exporting that we're doing. That comes out at $800,000. You'd actually deduct that $800,000 from your corporate tax return, and that converts into an IC disc dividend distribution. When you convert that into that dividend distribution, now you're being taxed, instead of at the 40% rough tax rate, you're being taxed at roughly a 20% tax rate on that. And so in this example, you would turn $320,000 in taxes that you'd owe on that $800,000 into $160,000. And so it can be if you're doing exporting, those are 6 letters that you want to know as IC disc. The other one is people. Everybody on this call, I think, has people in their organization. Annette, I'm here in your office, and I think I've seen some people walking around,
right,
so
right.
This may apply to you. A lot of things around this area right now. There's work opportunity tax credits, training programs that states are putting in place that they will actually pay 50% of your training costs in some case. Cafeteria plans, retirement plans. In some cases, if you have family employment or employees, there's ways to be able to do some transfer of taxation around to those employees. One thing I wanted to focus on, though, that a lot of people haven't heard about is the work opportunity tax credit. And that's this WOTC thing that's in this bucket. And what the work opportunity tax credit is, is it's a tax credit, goes directly against the taxes that you pay to the government. The great news about this particular credit is it's not subject to the alternative minimum tax. So this is actually a credit that can be taken against your taxable income. The key on this is that any eligible employee that you identify for this credit has to be identified, certified, and claims filed within 28 days of the hiring date. And so that's a reason that so many people aren't taking advantage of the work opportunity tax credit. One, because it's not easy to figure out who qualifies, and two, it's definitely not easy to get them certified with the state. That being said, there are companies out there that provide this service. We have a particular company that we work with, and they do an excellent job with a call-in number that your employees actually call. They do the certification for them on the line, or they screen them online, identify whether they would qualify, and then they actually do all the certification with the state, so that the only thing that the client has to do is just make sure that they pass on the credit amount to their CPA. So it's we've seen that be an incredibly effective way to do it, is to use these call-in companies, because then you don't have to train your HR department on how to screen. This just gives you an example of what some of the credits look like. You can get all the way up to $9,600 in credits for certain qualified disabled veterans. I will say in general the general credit's about $2,400. And how that's comes about is it's basically the first $6,000 of wages you get a 40% tax credit for. Who qualifies? Here's a list of all the people that are in the targeted group of who can get the credit. The big one on there is the second to last one. It's the Supplemental Nutrition Assistance Program, SNAP. That's basically food stamps. So if you're hiring people that are currently on food stamps, they're part of that targeted group, and they may actually qualify for the credit and be able to get that $2,400 per person credit. Got an example of here. This is just a rough thing I threw together that we're seeing across the board in manufacturing and distribution. Let's say you're a small company and you hire about 40 people a year. Now that can include turnover. So if you've got a high turnover shop and you're hiring people, that number can include turnover. If you're doing that, we say roughly about 20% of the people that you're hiring in a manufacturing, distribution, and even construction qualify for this credit if screened properly. So let's say out of that, 8 people qualify. The average credit comes out to about $2,400. That would be a total credit of $19,200. And so it's definitely enough. It's not a huge amount of money, but to me it's definitely enough money that if I saw it sitting in a bag on the side of the road, I'd probably pull over and pick it up. So this is one of those easy things that can be done that if you're not familiar with Work Opportunity Tax Credit or WOTC, those are 4 letters that you may want to become familiar with. I got to be careful when I say 4-letter words, don't I?
I know, yes.
Okay. All right.
Can I ask you a question about that, Scott?
Sure.
On that, though, when you are hiring someone, you can't ask them if they qualify for any of those things. So you really don't know. And then so you're saying like a company will help you to go through that process. But who do you put through that process? Everybody?
Generally everybody.
Okay.
And what we're seeing people do is to build it as part of their human resource process. Essentially they're onboarding. Yeah,
right.
The onboarding. They'll give them a sheet of paper saying, hey, as part of your onboarding, we need you to call this number and go through some screening on here, and then just turn this back to us, and we'll be able to finish signing you up. Now, got to keep in mind that you can't require them to do it, so you can't keep them from having a job if they won't do it. But we found that most of the time they will do it if you just make it part of the onboarding process, because at that point in time they really still want to be hired, right? And
right.
they want to complete it. So generally don't see a whole lot of pushback. Now, I would say the thing you want to be careful of is in the screening process. If you try to do the screening before hiring people, you are allowed to do that, okay? But you have to be extremely careful. And that's actually been a source of a lot of conflict around this particular credit is whether or not it can come across as discrimination if you start asking these questions during the interview process. So the EEOC actually did send out a release that they stated that you can ask the specific questions that needed to be done in order to get the Work Opportunity Tax Credit, and that falls under what they call the federal defense laws. So if you do it for that purpose, just for the Work Opportunity Tax Credit, you're fine. But then they followed up with this, but if you use this information for any other purpose than WOTC, then that could be discrimination. So that's a big but.
Right.
That's in there, because that but is all in the hands of whoever's making that decision.
Right.
It's one of the reasons we like using the third-party processors of the WOTC in this place, because there's a firewall then between asking the question. They know what questions to ask, and certainly if they did ask the wrong question, that information is not getting passed down to the owner. So there's a nice firewall that's there as well.
Yeah, good. That makes sense.
Did that answer
Yes.
your question? Great. Thank you. All right. So then moving on to the property area here, and cost segregation is something that I'm guessing most people have heard about, but that's essentially if you've got real estate, if you've got a building that you're using inside your business, if you're currently just depreciating that building over 39.5 years, just know that you can depreciate those buildings in some cases much, much, much faster by doing a cost segregation study, which essentially allows you to depreciate some of the what otherwise might be classified as building into perhaps equipment or improvements, which have a much quicker depreciation life. The other thing that's out there is bonus depreciation in Section 179. Those can be hugely beneficial, and I'm pretty sure most companies that would be on this call are taking advantage of that. But the point I would make about bonus in Section 179 at this point in time is it can be a great thing to be able to take that. But we get the $500,000 of equipment we put in place this year. We're going to take that all as a deduction. But what I've seen is a lot of companies will do that. They take all the deduction, but they're using some of that deduction against the lowest tax rates, or sometimes even throwing themselves into a loss situation by using bonus depreciation. And when they do that, they're actually burning up their personal exemptions. They might lose all the itemized deductions and things that are out there. So just know that just because the bonus depreciation Section 179 is out there in a year, you may not want to take advantage of it. And you actually want to run through the numbers and make sure, hey, how can I tax efficiently use these deductions? We talked a little bit about entity selection earlier. I'm going to pass on going through that right now. And accounting methods, one thing I'll pick up there because I know we got some construction companies on the line. If you're a construction company that is less than $10 million in sales over the past 3 years, you may actually qualify what's called the cash method of accounting versus the accrual method. We still see plenty of construction companies that are out there being taxed on an accrual basis of accounting when they may qualify for cash basis, which can be hugely beneficial if you depending on your numbers. The other thing I continue to see a lot of in many companies are prepaid expenses. If you've got prepaid expenses, prepaying insurance and some things at the beginning of the year that or last year that might apply to next year, if you actually used a lot of those within the next year, you actually do a change in accounting method for prepaid expenses and be able to deduct those actually in the year paid, not when the expense was actually incurred. The biggie that we see is insurance. In fact, we were going through a new client situation just this week. They had about $150,000 of prepaid insurance that they pay every year. We were actually able to move that to be a deductible expense in the current year rather than being pushed out into the following year. And then the other thing I would say is moving, we'll move past inventory and want to talk a little bit about risk management and talk a little bit about captive insurance companies. And essentially what captive insurance companies are insurance companies that you can actually own yourself. And that's another way, like the IC disc, where you might be able to convert some income that's otherwise taxed as ordinary taxable income into capital gain income, which can be huge benefit. Now, it does say insurance there, right? So this company actually must operate like a real insurance company. It must have valid claims. It must actually be paying claims. And the premiums are limited to $1.2 million a year. But we've seen some companies get a situation where they may save, $100,000, $200,000, $300,000 in taxes a year by using a captive insurance company. 3 things that you have to have in a captive insurance to be able to utilize that is a whole lot of taxable income, a whole lot of cash, and a lot of some uninsured risks that you may not have been taking into account in the past. So, Annette, I think you've been gathering some questions here that have been coming in from on the calls or on the chat.
Yes, here's one that under the R&D credit, has that been extended for 2015? So I guess it's been in past years. Are we going to have it in 2015?
Yeah, that's a great question. The R&D credit was introduced in 1981, okay, and it's expired numerous times, but it's been extended 16 times, and I believe has been in play for all of those years. So right now we don't know whether it's going to be extended, but if I had to put a bet down on it, I would say that it likely will be extended. And I think the big reason for that is there's bipartisan support for the R&D credit. Everyone seems to like that. In fact, in the Senate bill that was presented this year, they wanted to extend it for 2015, but it didn't make it all the way through committee. So we ended up just with the 2014 extension. So it was in play for 2014. Currently, not in play for 15, but I would make the bet that it will be, and I would probably, if you're going to do tax planning, I would probably assume that it would be in play.
But do you all not know that till the end of the year?
We don't. In a lot of cases, sometimes we don't, which leads to a big question. The R&D tax credit's an incentive-based credit, right? It
Right.
provides you for the incentive to do research and development tax, or research and development, just like the bonus depreciation, right? It's an incentive to try to get you to buy equipment throughout the year. Neither one of those, bonus depreciation, research and development tax credits, we didn't know that they applied in 2014 until 2015 came about. It actually did not hit the extender bill. So in those cases, some of the times we're working with best information that we can get. What do we think will happen? So we continue to watch what's happening on the Hill. But yeah, it's a huge frustration for our clients, a huge frustration for all business owners, is this tax uncertainty. It's one thing to know what the rules are and be able to plan for that throughout the year. It's another thing not to know what the rules are. What's the game? What are the rules of the game? So that's my long answer to is R&D credit in play? It's currently not. We don't know.
But hopefully it will be.
But hopefully it will be.
Right.
Sorry.
Then I had somebody else that asked a question on the IC disc on the international. Do I have to export directly to another country?
No, actually you don't. You do have to know that what you made is going to be exported, but you can actually use an export intermediary. You can actually, if you know that it's going to be distributed by someone outside of the country, you can still qualify for that. In fact, if you make something that's going to go into a product that you know is going to be exported, you may still qualify to be able to do the IC disc as well.
Interesting. Interesting. I think that was all the questions that we had. Do you see any others on there?
Let me see. I do. I see one. Here's a question. Oh, this one is, will the slides be available after the presentation?
Absolutely. We will. The whole presentation has been recorded, so we will send that recording out to everyone. You should have it probably tomorrow. So, yes, it will be.
Great.
That's it? Okay,
That's
great.
all I'm seeing.
Great. Okay. Well, we appreciate everyone coming today, and please look for the emailer with the recording on that. And if you have any questions, either for Scott or myself, please let us know. Our information will be on that emailer. And we hope you guys have a good rest of the day, and hope you don't lose any money on the Derby. And if you have any good horse picks, remember, send them to Scott.
Yep, thank you.
Thanks, you all.